2025 has been another great year in the stock market. In fact, the last couple of years in the stock market have been spectacular. Now your equities probably have grown to be a pretty significant increase and have some major gains inside of there. The scary truth, though, is that for most retirees, they've got to kind of figure out the balance between protecting what they have as well as growing their money. Today, what I'm going to do is I'm going to show you exactly when and why you might want to consider locking in some profits and why to do it even when everybody's still betting big time on the market. So I'll give you an example. Bob and Jenny, they came to our office recently for their yearly portfolio review. They're semi-retired. They wanted to talk about some of the plans that they had next year, and I really like their plans that they have coming up. They're looking to take a couple of cruises, enjoy life, and they're kind of tossing around the idea of go ahead and not being semi-retired, fully retiring, which would mean that they need to generate a little bit more income. What I'm going to do is I'm going to walk you through the plan that we put in place for them to help them keep growing their assets, but also protect some of the profits and help add in more predictable income that they have. So if you're thinking about selling stocks, the first thing that I want you to do is I want you to start with the why. And let me explain what I mean by the why. When you're working, the goal was simple, right? Grow your money, compound interest, max out the 401k, ride out the volatility. But in retirement, the goals shift to preserving income and protecting your lifestyle. So locking in profits isn't about trying to time the markets. It's more so in tying it to your retirement goals. So going back to Bob and Jenny, they have some near-term goals like that increased income. They have a couple of vacations that they want to plan for in the next couple of years. Locking in some of their investment gains and, knowing that they're like $65,000 ahead of what their goal is this year is a great why the market is ahead of their goals and where they're at. I have another client that we meet with on a regular basis, and his goal is to have double-digit returns every year. So, he's trying to shoot for a 10% return in his portfolio. In the years that he hits that number, those are the whys on where he would begin to pull back and reduce the risk that he has. So again, in the last couple of years, as the markets had those rallies, that's the point where he wants to start looking to protect profits. So you might want to have a predetermined goal. Again, look at what your near-term upcoming expenses are. If you're ahead of the game, that could be a reason why to take some money, put it on the side. Or if you have a targeted return that you're shooting for and you've exceeded the goals, then you've been able to do that. So what I want you to do, again, number one, start with your why. If you answer the why, it's going to help you remove it or at least reduce your emotional decision of buying and selling, right? A lot of times people make these emotional decisions like, I think what's going to happen in government, what's happening overseas, what's happening here, there, what I read on the news headline, those emotional decisions to buy and sell, we want to get that out of there and make it more about the reasons why. Number two, the reasons why you might want to consider locking in some profits is when the markets start to lose touch with reality. And what I'm looking at is when the markets really get ahead of some of their fundamentals. That's why it's so important right now to know what you own. We go through those 5 criteria on when we pick investments, right? We want companies that are cash rich, low debt, have high profits, companies that have a competitive advantage and or are needed on a daily basis. Doing that is not necessarily being a market timer. Nobody really can predict the top of the market, but when you see valuations on some of the investments that are out there, and when you see that 7 stocks are doing the heavy lifting of the entire S&P 500 index, and when everybody, even their uncle, is talking about how easy it is to make money in markets, that concentration risk is building up, and that concentration risk is really dangerous until it's not silent anymore. Locking in your profits doesn't mean selling everything. It means trimming some of those oversized positions, rebalancing back to your target allocation. So let's say your technology equity stocks are up And, that's now technology or growth is 25% of your portfolio when your desired outcome was to have it 15%. That's a gift that you have from the stock market of that growth. Good time to unwrap that gift, rebalance back to the original allocation. So there should be something that you do when the markets get out of control and the markets grow a little bit faster, like we've seen in the last couple of years. So if you haven't rebalanced your portfolio in 6 to 12 months, that would be another why to consider that. Number 3 is you want to match what your time frame is. Evaluate what your income needs are. So going back again to Bob and Jenny's situation, they're working part-time, but if they stop working completely, they need their investments to generate more income in their portfolio. And in my opinion, there are other investments to consider besides stocks alone to lock in generating predictable income. Now, in Bob and Jenny's situation, I'm perfectly fine with still having a decent part of the portfolio, maybe 70% of it. So could be involved in equities based upon who they are, what their comfort level is, and investing in their allocation. But, maybe they take 30% and protect it. Why would that be important is if they're increasing their income, they're taking higher withdrawals from their accounts, what they need to worry and protect against is called the sequence of return risk. And I'll talk a little bit more about that in a second. But, the way that we structure the process of putting this together and building this out is our philosophy is called the independent income system. So you have a bucket of money that's designed for reliable income, a bucket of money that's designed to give you a pay raise. You have your long-term growth account, and then you have money set aside for different emergency or specific goals that you have coming up in the next, say, 1 to 3 years that you have. When the market runs up as strong as it has, you have the ability to take money and then increase some of your other buckets. Essentially, you're turning volatility into certainty by protecting those profits that you have, and that could be a powerful move into making these type of markets that you have. Number 4 is the biggest risk that you have in retirement that maybe you weren't aware of is the sequence of return orders. And, if you look at it, a young person, 20, 30, what happens in the market in the next couple of years, it doesn't really impact what the sequence of returns of their portfolio is over time. So if the market goes down and you're 30, just keep putting more money into your 401k. But if you're retired and the market drops 30% and you're pulling money out of that account for living expenses, you ultimately get forced in a situation to be selling low. You're locking in losses and your portfolio may never recover in retirement, even if the market does. So locking in profits in a strong rally, say by moving 10, 20, 30% out of equities into some more stable assets, what you've done is you've now just protected a couple of more years of retirement income. You've given yourself a backup plan. When I was in the United States Marine Corps, they always taught you to have a backup plan. And having a backup plan can give you a safety net, give you a little bit more peace of mind. That's not fear. That's just smart engineering at retirement time. Point number 5 is taxes and emotions. Now, I know that some of you are thinking, but what about taxes? Won't I just get crushed in taxes if I, sell some of my stocks? And really, that depends. You want to be strategic on how you make these decisions. So using my portfolio as an example, I have some money in a Roth IRA, I have some money in a traditional tax-deferred IRA, and I have money in a taxable account. If I make changes in my taxable account and I sell certain things, that would be reportable if I have profits inside of there. So that may not be the best place on where I want to make changes. Now, in my 401k or in my IRA, I can move money around as long as I'm not taking a withdrawal. It's not a taxable event. So you have the ability where if you have multiple different accounts, you can pick, and doing so will help you minimize making sure that you don't get surprised with any taxes that come up. And then you want to reinvest with purpose. And what I mean by that is, if you're going to lock in profits, you can still look at other investments that are great opportunities, maybe that have growth, maybe that have protection, maybe that have income. You want to reallocate to match your investment goals. That money could get invested into guaranteed sources like, fixed annuities, bank CDs, You can have investments that you want to fight off inflation, certain types of vehicles that provide income in the future. You could look at maybe generating more tax-free income, things like Roth conversions, municipal bonds. The goal is not necessarily to just sit on the sidelines and take the money out and say, well, I'll get back in when I feel better. The goal, again, is to know your why, not market timing, not fear, just smart, intelligent asset allocation that involves with your needs and what you have as well. We had another client that was concerned about long-term care. We ran this tax what-if analysis, and we discovered that they had the ability to take out a nice amount of money out of their retirement account and still stay in the lower tax bracket. When we did the tax what-if analysis, we talked about things like a Roth conversion. Again, oftentimes can be a great solution for people. But also we had shown him where he could lock in some of the profits and he could move the investment over into a life leverage plan. By moving it into the life leverage plan, what it did is it allowed him to be in an investment that still had great growth potential, but it picked up some long-term care benefits, and it picked up an enhanced life insurance benefit to protect his spouse. Heaven forbid, he passed away. So, when you think about it and we look at the markets, we've seen major market downturns, right? I think in my career, I've seen 2000, I've seen 2008, I've seen COVID, 2020, 22. Now imagine if locking in 15% of your gains before something bad happens and you moved it to safety, it could reduce your stress. It could maybe extend the life of your portfolio and allow you to sleep better at night. At retirement, it's worth more than trying to squeeze out an extra 2% of the return if the market's not at the all-time high. So locking in profits doesn't mean you're bearish about the economy. I also want to make sure that you don't just make an emotional decision to buy or sell. I want you to follow a disciplined strategy, and I want you to start by answering the reason on why. If we turn that success, it can help you build more lifetime security with your overall plan. If you're within 5 years of retirement, you're already retired, you've had a great run in the market. Now might be a time that you want to take a look at it. Don't wait until the next crash that you have. If you want a personalized plan, you want to know what my advice would be on where you might want to consider locking in profits, get a hold of us at arhq.com. Click on that retirement team action plan. We can provide you an independent portfolio analysis and give you some advice and feedback as well, and know whether now could be a good time to lock in some of the profits that you have in your accounts. We're always happy to help.